All right, so we're down to sort of our last two as aspects of the financial statement, and I think the cash flow statement and the notes to the financial statement are going to be really quick and quite simple because they're mostly interpretive. There's a lot of information you can get from the cash flow statement, but you won't have to calculate. Again, note that for commercial banking, not all companies will supply a cash flow statement. So that's why we had to go through, all the steps of calculating it from the income statement and balance sheet. To start, let's look at the top here just to help you conceptualize what a cash flow statement is. Let's say that you own a lemonade stand and you sell $10,000 of product on a day. Lemonade stand probably wasn't the best example because you're not going to sell $10,000 of it in a single day, but let's just say that you do. Most people nowadays with their fancy rewards credit cards are going to pay on credit, right? So you know that if they pay on a credit card, they have like 21 or a month, 30 days to pay it. So that means that you as the business are not getting the cash right away. So you're going to get the cash later because they bought it on credit. So obviously that doesn't take into consideration some companies can factor the credit, which means that they can pay a company to get the payment faster, but then the company, only gives them 95% of their sales. Now that's a whole different conversation, but I thought that's interesting to know. So anyways, back to the idea here. You sell $10,000 of product. You can immediately kind of write it down as a sale or revenue, right? So you can write down $10,000 immediately in revenue, but do you get $10,000 in cash? No, you don't. So that's how the cash flow statement comes in handy because it helps you kind of better track and understand how the cash moved, right? Because, just because a sale happens or some transaction happens, there's some things on the statements that are not cash. And another good example is amortization. We talked about amortization. Amortization is basically when you have equipment or property that you purchase and every year the useful life of that equipment or property decreases. The classic example is if you buy a car, the moment you drive it off the lot, it loses some value, and every year it loses some value. So when the car loses value, people are going to pay less for it, right? Maybe you pay $50,000 for a car, and the next year people are only going to be willing to pay you $40,000 for that car, depending on the mileage and usage, etc. But that $10,000 cost to you is not cash. You don't lose $10,000 cash. You lose it like it's a non-cash loss for you. So that kind of, hopefully you understand how certain transactions and certain expenses could be non-cash. So the cash flow statement really only captures the real cash items for a business. So if we look down here, just to recap, the three different kinds of major statements, right, in a set of financial statements is one, you have the income statement that tells you how the company performed, how profitable it is over a 1 year period, okay? And then the balance sheet is the net worth of a company, how much asset it has versus liabilities, and what kind of things they have in their balance sheet specifically at a specific point in time. It usually coincides with the year end of the company. Just like how the income statement measures from the previous year end to this current year end. That's why the business has established year ends. And then finally, like we just talked about, the cash flow statement, which will help you understand the movement and the flow of cash in the three categories of business. And we're going to talk about that. So like usual, we're going to start with a bird's eye view, a more kind of general overview of the cash flow statement. This isn't how it's going to actually look. We're going to expand it in the next slide. and then go into the granular parts of it. So first, of course, at the top, you're going to always be reminded of the fiscal year end for the company, what company it is, and what form of statement it is. Okay. And then I guess the most important thing to know, and I'm going to write it in, maybe it'll be helpful if I write it in numbers. It's always going to be presented in this order. And then there's always going to be 3 major subsections. So let me switch to highlighter. Hopefully this helps here. So we have orange, green, and blue. Okay, let's go back to red. Okay, so there's 3 sections here. So the first subsection is operating activities. If you want to think about operating activities, it is the day-to-day business. Okay, so these 3 subsections again are the different avenues that a business can either have cash flow out or come in. Okay, these are the only 3. Like every single activity of the business can be categorized in these 3 subsections. Okay, so the first one is operating activities. It is the day-to-day of a business. So how the cash is made from running the business. So for example, it's like if you collect money from customers who paid you on credit, that cash comes in. That's going to be captured in the operating activities. If you pay suppliers, like if you're running the lemonade stand and you have to pay a company for the lemons, that gets captured in the operating activities. If you have to pay the salaries of your workers, that gets captured in the operating activities. So everything related to the core operations of the business and how cash moves around will be captured in the first subsection. Okay, that's why it's at the top, operating activities. Now the next subsection is the investing activities. Okay, so investing activities, you can think of it as just like long-term assets. You can actually think of it as fixed assets. Remember how I said in the previous video, unfinanced capex, the easiest way to solve it is through the cash flow statement? Well, you're about to see that, right? So for this subsection, for investing activities, it describes how cash is used to buy or sell fixed assets, or those big machinery, properties, facilities, vehicles, those kind of fixed assets. When you buy them or when you sell them, obviously sometimes you have to sell it because you don't need it anymore. Any of the cash movement from that is captured in the investing activities. Okay, so the idea is like all of the stuff that happens here it's called investing because you need those things to either grow your business bigger, right? You're going to need more warehouses and more vehicles, more equipment, or you're going to downsize, right, by selling vehicles, properties, warehouses, equipment. And then the final subsection is financing activities. So financing activities, you can think of it as how I would say, well, it's in the name. It has to do with financing. It's basically if the business needs money, right? Like if the money that they have or they generate through their operating activities is not enough. Because in the beginning, you can't, like before you, in the very early phases of a business, you need a loan. You can't just rely on, like before the business grows big enough, it might not be able to sustain all the cash flow needs, like with its own operating cash flows. Okay, so it's like how is it financed, or how the business is, you can think of it, how is it funded? Okay, so just some examples is like if the business borrows money or pays back money, those cash flows will be captured in the financing activities. Oh, I just realized I have a little typo here. This is the not operating, it's financing. Okay, financing, and that error is probably going to carry through to the next slide. But I'm not going to re-record this slide just for that. So excuse that little typo. Yeah, so if the company's borrowing money or repaying principal for their debt, it's going to be captured in the financing activities. If they pay dividends or issue more shares, and then they get money or they buy back some shares or any kind of cash flow through those kind of things will be captured in the financing activities. And then at the very bottom, I know I highlighted it just because I wanted to separate this from the beginning and ending balance. But this at the bottom is kind of is the whole purpose of a cash flow statement and how it's useful. So it's going to tell you over the year, is there more cash or less cash? Obviously, cash is so important, and it's, EBITDA, that's the first time we talk about cash flows, but I can't stress this enough that cash flows is what enables a business to kind of be healthy and surviving, right? Like cash flow is like the blood flow inside of a human. Blood flow drives all of our organs, the function of our brain, our heart, etc. And cash flows does the same thing for a business, right? Even no matter how strong a business's balance sheet is, like they could have all the net worth in the world, but if they're illiquid, which means they can't get cash, and then they need cash, they could default on their obligations. Like if they borrow money, obviously you have to pay it, and then if they don't manage their cash well enough, they will be short. They will be short, right? You'll have a cash flow deficit, and if they can't raise that money, there might be legal implications, or they might miss out on opportunities, or sometimes a company grows so fast and then they fail, or they get bankrupt even though they look like they were growing really rapidly. It's because mismanagement of cash flows, right? So this at the bottom really tells you, like, it's a tool to help manage those cash flows, because it tells you how the cash has changed in each year, what the beginning balance is. So if you see a negative, right, obviously they're living in an operating line, so like an overdraft. So if they're negative 41,000, it means they're like $41,000 inside their operating line or overdraft protection, however you want to think about it. So you don't want to obviously have too much cash, but you also don't want to have too little cash. So this thing at the bottom will track that. And this, the change in cash is the sum of all the cash inflows and outflows from the three activities. The sum of those is the net change in cash. And then the net change in cash, you're going to see how at the beginning of 2024, there was 41,000. And then you're just going to add the change, whether it's positive or negative, and then you're going to get the ending cash, right? So the very bottom ending cash balance is where is the most current state. So if you're looking at the statement right now and the company just gave it to you, probably 140,000 is what they had at the beginning of 2026, because that's at the end of 2025. Okay, so hopefully this is helpful. It's mostly very conceptual. It's just teaching you how to interpret those major categories and explaining what the categories are. And the next slide, we're going to open it up. So expanding the categories into their full statement size. So this is the fully expanded out version of the cash flow statement that you can expect to see in the real deal. Somebody who's went over most of the videos already, she came and told me that when she tried to apply it, there's some nuances, right? Some nuances with the actual statements that you see versus the ones that I'm presenting here. The ones I'm presenting here are very standard, and even among standard accountants, they might have slight different ways that they're going to name things. Some of those are a matter of preference, but I think what we also discovered is that, like, if we cover things well here, those little nuances, you're going to be able to use your skills, your newfound skills at reading statements, and you're going to be able to tell, even if they don't explicitly label it out for you, you'll know that it belongs, wherever. So when you have that realization, give yourself a pat on the back, because it means that you're really developing some skills here. So this fully expanded out statement really tells you where, how you get to the net cash from operating activities. And of course, this one is financing, not operating. Financing. Okay, you get the gist. So it's going to tell you based on these accounts, similar to income statement and balance sheet, the way that we did it before, all the individual items that produce your net cash, whether it's an inflow or outflow. For the cash flow statement, one thing I want to say is if it's an outflow, it's usually going to be shown as a negative. So if you have a negative, and also just like the income statement, the cash flow statement applies to that year for the whole year. Okay, so in that sense, keep in mind that the income statement and the cash flow statement, they're very similar because it applies to the whole 1 year period. So let's just try to read let's read the 2025 one, 2025 column. So we start at a very common place like net income, 120,000. That's actually gonna be the money that, well, I wouldn't say that's the money that flows into the company. The reason why they start in the operating activities from net income is because that's the starting point. You remember how EBITDA, we get EBITDA starting from earnings, and earnings is net income, right? So this process right here, actually, this is very interesting. This process, that extra line. Okay, so this process of calculating the net cash from operating activities is very similar to EBITDA. It's not the same, but it's very it's very reminiscent of how we calculated EBITDA. It starts at net income, right? And then it makes adjustments. So amortization is not a real cash, like nothing happens to the cash, but it's listed as an expense. So because of that, because it's a non-cash item, you have to add it back. So this is a positive number. Okay, so think about that for a second. You start at the very bottom. Net income already took out amortization expense, right? Remember, net income is at the very bottom of the income statement. So amortization was already an expense that got deducted, but because it's not a real cash expense, we just talked about it in one of the previous slides, we have to add it back because that cash never left the bank account. It's just a fake, like a non-cash expense. Okay. Then you have real cash items, like if your accounts receivable, I don't know if we talked about this, but for a business, an account receivable is like basically when your customers buy stuff from you on credit, your account receivable increases because you're going to receive that accounts receivable, that amount in cash in the future. But this just tells you how it changed. And because it's a negative number, you know that the accounts receivables changed in a way year over year that implies that there's a cash outflow of 15,000. So we can actually, if you have to take some time to think about it, but if it's a negative 15,000, it means 15,000 in cash, like, is an outflow. What that really means is that people, like, the changing accounts receivable means that there's more buildup of credit that you didn't collect cash for than there was, the other direction. And then same in changing inventory and changing accounts receivable. Inventory is like, when you spend money to buy for the lemonade, it's when you buy the lemons and the water. So if there's a change, like if inventory increases year over year, then you spend money to buy more lemons, etc. But you don't have to do the calculation. It just tells you right here on the cash flow statement, which is something I really enjoy. So you just know that there's an inflow from inventory, inflow from accounts payable. Whatever the changes, you don't even have to think about that. We did that a lot for balance sheet, but here it just tells you what it actually is. So if you have any questions about this, we can go over it line by line individually, but just know that each of these items are already calculated out for you. So you can just attribute them. Okay, so the total cash from operating activities for 2025 is 148,000. Okay, so that's the amount of cash that, like, they could have a net income of 120,000, right? That's their net income, but actually they generated $148,000 worth of cash to work with. And then for investing activities, you see purchase of PP&E. This sounds very familiar to, what did we say? CapEx, right? That's literally CapEx. You don't have to solve anything. If you have a cash flow statement, I highly recommend just go to the cash flow statement and look at purchase of PP&E. It'll be there. And if you calculate it using the balance sheet and all that stuff, you're going to get the exact same number. So CapEx is 60,000. And then the proceeds from sale of PP&E is, when you sell equipment after you don't need it anymore, that also gets captured here. So the total net cash from investing activities is, well, negative 48,000. So I hope that all makes sense. It just means everything related to buying PP&E usually shows up here. Whether you're buying it or selling it, it'll all show up here. And then finally, the financing activities. Remember how unfinanced capex is equal to capex minus financing, right? This is the simplified version, of course, of that formula. So capex here, right here, purchase of PP&E, that's capex. So that's 60,000. I know they write it as negative 60,000, but like that means cash went out to buy this equipment, but it's actually 60,000 here. So I hope that makes sense. I know it gets confusing with the sign sometimes, but you just got to think about it the way they write it here, because you're paying money, the money's going out of your company. But when you write it here for unfinanced capex, this is how much the expenditure was. It's not a negative expenditure, it's a positive expenditure. And then if you minus financing, you're going to be looking here in the financing activities. So none of these are actually financed. Like there is no financing, right? Repaying debt is not financing. Issuing dividends is not financing, and then issuing stock is also not financing. What you would actually be looking for is a line item called proceeds from debt. It's not here in this example, but there would be a line item that says proceeds from from some kind of debt. It's going to be written not exactly this way every time, but something similar to that, proceeds from debt. If there's an item like that, then it would be financing. So in this case, based on this cash flow statement, the unfinanced capex, because financing is 0, would just be 60,000. Okay, so hope you followed that. And you just have to be able to read these items. Just know that the cash flow statement really just summarizes the cash flows from different activities. Do we actually need to use the cash flow statement a lot in commercial banking, you might ask? Well, I mean, it's another way you can find the amortization, right? Otherwise, no. Like, do you actually use any of this? Not too much. The one thing I would say I use it a lot for is this PP&E thing. Like if I have a cash flow statement, I'm never doing the calculation for capex. I'm always just going to the cash flow statement and looking at purchase of PP&E and looking at financing to see if there's any financing to calculate unfinanced capex. Okay, and then we explained how this bottom part works in the previous slide. So there isn't really much you need to calculate with. It's really just reading it, and I'm giving you another way you can basically calculate unfinanced capex easier through the cash flow statement. One last thing I would say is what the other thing that actually shows up in the financing activities is distributions. Okay, I know it doesn't show up here, which I should have actually incorporated into this lesson, I know, but if there's any distributions, it will also show up here. So then you don't have to calculate either unfinanced capex or distributions. I don't think cash taxes shows up, so that one you always have to calculate yourself. But unfinanced capex and distributions, if there's a cash flow statement, you can go right to the cash flow statement and it'll tell you inflow or outflow, what that number is. The only trick is there's some negatives and positives that are listed with the cash flow statement. You have to sometimes think about Like, for example, with the unfinanced capex, you're not putting negative 60,000. You put 60,000. The negative is because you know it's a purchase and the money is going out of the company. Okay, so hope that makes sense. If it doesn't, please feel free to reach out. And then I promise the notes to the financial statement should be a short one. And I mean, I know this one's a bit long, but conceptually, it's not. It's just a matter of learning how to read it. There's no calculations here.